Most people walk into a car dealership thinking the negotiation is about the price of the car. That's exactly what the dealership wants you to think. Because the real money, the profit the finance and insurance manager makes, isn't in the car price. It's in the interest rate markup, the extended warranty, the GAP insurance, the paint protection package, and the tire and wheel protection plan. I'm going to show you every single profit center the F&I office uses, what they actually cost the dealership to provide, and exactly how to counter each one. The car buying process is designed to exhaust your decision-making capacity. You spend hours test driving, negotiating on price, trading in your old car. By the time you get to the finance office, you're mentally depleted and ready to sign. The F&I office knows this and times it accordingly. They've also shifted your focus to monthly payments. How much can you afford per month rather than total cost? Because a $50 per month difference over 72 months is $3,600, but it doesn't feel like $3,600 when it's framed as just $50. Dealer reserve, the interest rate markup, is the primary F&I profit center. Here's how it works. The lender, Bank of America, Capital One, Chase, offers the dealer a buy rate. Say it's 5.5% for your credit profile. The dealer has permission to mark this rate up, typically up to 2.5 percentage points, and keep the difference. So the dealer quotes you 7.5% while funding the loan at 5.5%. On a $35,000 loan over 60 months, that 2% markup costs you roughly $1,900 in extra interest over the loan term. The F&I manager pockets that as a commission. The counter to dealer reserve: get pre-approved through your own bank or credit union before you walk in. Log into your bank's website, Capital One Auto Navigator, or your credit union, and get a pre-approval for the loan amount you need. Your pre-approval has a rate tied to your credit score. This is your baseline. When the dealership quotes you a financing rate, compare it to your pre-approval. If the dealer can beat your rate, great. If not, you use your own financing. This eliminates the entire dealer reserve game because you're bringing your own money. Extended warranties, called service contracts, are the highest margin product in the F&I office. A warranty that costs the dealer $600 to $800 from the provider is sold to you for $2,000 to $3,500. The markup is 200 to 400%. Many extended warranties have so many exclusions that they don't cover the most common repairs. And for new cars, the manufacturer's warranty already covers you for 3 years and 36,000 miles on bumper to bumper. You're essentially being asked to buy a backup for a warranty you already have. If you want extended coverage, buy it from the manufacturer directly, not through the dealer. GAP Insurance, Guaranteed Asset Protection, pays the difference between what you owe on the car and what insurance pays if the car is totaled. This is a real product with real value, especially if you're financing with less than 20% down. The problem is that dealers charge $400 to $900 for GAP coverage that your own auto insurer will sell you for $20 to $40 per year, literally $60 to $120 over the 3 to 4 years you might need it. If you need GAP insurance, and you might, buy it from your car insurance company. Never from the dealer. Paint protection packages, tire and wheel protection, key replacement, and nitrogen in the tires are dealer add-ons that are almost never worth the price. Paint protection, ceramic coating, or paint sealant applied before delivery costs $200 to $400 at a detailer and is sold for $1,000 to $2,500 at the dealership. Nitrogen in tires provides minimal real-world benefit over regular air. The atmosphere is already 78% nitrogen. The standard response to every add-on offered in the F&I office: I'm not interested in any add-on products. Say it once, calmly, and don't elaborate. Negotiate the out-the-door price, not the monthly payment. Out the door means the total price including all taxes, fees, and dealer-added items, the actual number you'll be writing a check for or financing. Dealers love to anchor on monthly payments because stretching a loan from 48 to 72 months can hide a $4,000 price increase while changing the monthly payment by only $30. Always ask for the out-the-door number first. Calculate what a fair price is using, Edmunds True Market Value or Kelley Blue Book, before you walk in. The most powerful negotiating tool, being willing to walk away. Dealers work on commission. An unsold car earns no commission. If you've negotiated to a number that's still too high and the dealer won't move, stand up, thank them for their time, and leave. More often than not, someone will follow you to the parking lot with a better number, and if they don't, the same car exists at another dealership. Getting quotes from 2 or 3 competing dealers in writing, via email, and letting them compete for your business produces the best outcome with the least emotional wear. The car industry makes billions per year on information asymmetry. Buyers not knowing the buy rate, not knowing add-on product margins, not knowing they can buy GAP insurance elsewhere for a fraction of the price. Now you know. Pre-approved financing, out the door price, no add-ons, willing to walk away. That's the entire playbook. If you want to understand how negotiation works in another high-stakes context, specifically salary negotiation, which has a similar structure of information asymmetry, we have a dedicated video on exactly how to approach that conversation.